Hello to everyone. Today I am here with Come with Business New Idea Part 4. If you are interested to have update videos on banking and finance related topic, please do subscribe my channel. In this session, we are going to calculate the business cash flow development. And in the previous section, we have covered the premises, acquiring expenditure, capital expenditure calculation, monthly expenditure calculation, and total capital requirement, that is initial cash outlay. And further, we have also discussed about the services and the revenue that will come to the business. First of all, we have cash inflows that include owner's equity, retained earnings, borrowings, and revenue. These are the cash inflows. Owners contribute their money in the shape of equity. Retained earning is the part of the profit that we reinvest within the business, and borrowings are the amount we borrow from the different sources. Sources can be from family and friends and from financial institutions. And on the other side, all types of the revenues is also a part of cash inflow. The cash outflows include all type of the expenditure, thereafter capital expenditure, in order to utilize our business required fixed assets that include fixtures, furniture, equipment, machinery, vehicle. And on the other side, purchases and the repayment is a part of your cash outflows. Here we have the schedule for the depreciation. We have, first of all, fixture having a useful life of 5 years. Thereafter, we have the furniture. Furniture also having a useful life of 5 years, and equipment having a useful life of 3 years. If you have vehicles having 10 years useful life. Now, first of all, the value for the fixtures come to 374,000, and its average monthly depreciation comes to 20%. It means 74800 will be divided equally in 5 parts. Thereafter, furniture, it's also having a 20% share that comes to yearly basis. On the other side, equipment will be fully depreciated with the period of 3 years. So the total for the first 3 years come to 737,523, and for last 2 years it comes to 10920. Now we are going to develop the cash flow on the basis of the calculations we have that include some of the calculations from our previous slide. Like here we have the premises calculation that we have already covered in the previous lecture. Thereafter, we have the fixtures calculation. It's also covered in the previous lecture. Thereafter, we have the furniture calculation and equipment calculation. And the total of the capital expenditure calculations can be reviewed again from this Excel sheet. Here we have the expenditures detail that we have also covered in our previous lecture. These are the revenue or the services. It's also covered in the previous lecture. The total amount up till this we have already covered in our previous lecture. Here we have the schedule for the depreciation that we have just reviewed in our slide. Now here we are going to develop the cash flows for our business. Starting cash. Here we have the figure for the starting cash. Starting cash means 8 months expenses that you have kept with you as the running financial for your business. So that is considered to be the starting cash for your business. Now here we have the first month expenditure that comes to equal to 299,299,000. Okay. It includes salaries, electricity bill, mobile charges, water charges, maintenance, refreshment, medicine, and other expenditures. Now, here we have already paid the rent for first 2 months. That's why the rent amount is not appearing for the first 2 months because we have paid 2 months rent in advance. For the second month, you can see the revenue comes through. We have 24 patients. 20 comes again for consultancy. 2 patients comes for the food extraction and scaling and polishing. There are 2 patients. So total revenue we generate in the second month come to 52,000. And here we have the detail of the expenditure. Okay. For the first month, we are facing a loss of 1,117,000. Here we have totally having a loss of 2,99,000 because during the first one we were not operational. We were only busy for the setup of our business. So total expenditures we have beared as a part of our expenditure without having any revenue. Now, for the second month, the patient number increases to 35 and detail of the revenue is as follows. 28 against the consultancy, 3 for the total extraction, and 5 patient comes for scaling and polishing. Here we have 1 patient for the scaling and we have 1 extract. Similarly, here we have the 40, then 50 patient, again 50 patient, 60 patient, 65 patients, 65 patients, 70 patients, 80 patients, and 85 patients. It's the detail, monthly detail of the revenue. And these are all projected figures, not the actual figure. On the basis of this assessment, our first year revenue come to 1,845,300 for the first year. Total expenditure for the first year comes to 2,828,000. So for the first year, we have a deficit equal to 9,46,700. These are the calculations for the first year. Now, in the next video, we will develop the projections for 5 years and also apply the capital budgeting technique in order to assess the viability of the business. Thank you very much. See you very soon with the upcoming video with the application of financial modeling, that is capital budgeting technique.